Hey, this is Paul with your Winning Investor Daily. The markets are freaking out. On Tuesday, the Dow Jones Industrial Average dropped, really dropped by 795 points in one session. Boom. What's going on? Why is this happening? Well, if you believe the financial websites like MarketWatch, Yahoo Finance, or if you read the Wall Street Journal, the New York Times, any of these publications, what you'll start to see is this term, this jargony term called the inverted yield curve. So what is this inverted yield curve, and why is it something that stock market investors fear? Well, first, let's quickly go into this inverted yield curve. So the inverted yield curve is something that refers to interest rates and the bond market. And in anything that you're reading, it specifically refers to the market for US government bonds. Our government, the United States government, is regularly selling bonds virtually every week. So you can go look up and see what an investor is getting this week when they buy a 1-year US Treasury bond, as they're referred to. And you can also go and look up what someone is getting when they buy a 10-year US Treasury bond. And most times, the interest rate on the 10-year bond is higher than the interest rate on the 1-year bond. And that makes sense because in recent history anyway, we've had inflation. In other words, the government is going about creating inflation at a rate of something like 2%. So it makes sense that if you're buying a bond where you're expecting to get your money back in 10 years, just to keep up with inflation, you would have to get a rate of at least 2%, and you'd want some reward on top of that. So it makes sense for that interest rate to be higher than 1 year. So this inverted yield curve that you'll see referred to on all these websites is referring to the fact that right now, if you go and look at it, the 1-year bond is actually giving you a higher interest rate than the 10-year bond. And that strikes a lot of people as being a bit weird, a bit strange. And if you're on Wall Street, it also strikes fear into your heart. And why is that? And if you go and read the articles, you'll get a bit of an explanation, and you'll see that many people will say, well, an inverted yield curve has preceded many recessions and has preceded many crises. However, when you actually break this down a little bit further and you think about it through like, well, why would someone actually go and buy a 10-year bond when the 1-year bond is giving them a higher rate of interest? And the reason why someone would do this is because they look at what is going on in our economy and they think that economic growth is going to slow down and that people are going to start hoarding money, and that this interest rate on the 10-year bond at some point in time will go back to being higher than what you would get on the 1-year bond, because into any economic weakness, what happens is the Federal Reserve will lower interest rates and the 1-year bond will go down, and eventually the yield curve, which is currently inverted, meaning that the 10-year bond gives you a higher interest rate than the 1-year bond, goes back to being a regular yield curve where the 1-year bond has a lower interest rate and the 10-year bond has a higher interest rate. Now, normally, I would go with this explanation. And if I was going with this explanation, I would be telling my subscribers for my Profits Unlimited service and my True Momentum service, my Extreme Fortune service, that they should really sell their stocks and prepare for a bear market, for a problem market of some sort where stocks go down and go down a lot and are repriced for much lower levels of economic activity. However, I believe that there is something different going on today. And it's a very unusual thing that is happening, which is that we have so much technological development going on and so much technology that it is creating what I believe is a deflationary boom. Now, you will struggle to find a lot on deflationary booms because we've really only experienced one or two of these. And if you go on Google and search for it, you'll see that we experienced this in the late 1800s, as we also had a convergence of technologies occur at the same time, where we had multiple developments in transportation, multiple developments in communication, and all of this also caused a deflationary boom. And by that, I mean that prices went down even as we had economic growth. And that is something that is very different, very unusual, and only occurs during a point in time when you have a lot of different technologies coming together all at once. And these technologies make things better, faster, cheaper. And as a result, that move prices down. And in that period, you would expect the yield curve to be inverted, because what is likely to happen is that you are going to expect lower prices over time. And because of that, you would expect to lock in interest rates on the 10-year bond, because you believe and you know that the interest rate that is there on the 1-year bond eventually is going to go down, not because there's going to be economic weakness, but because there's really no reason for them to be this high, because we are in a period of deflation instead of inflation, driven by technological progress. And this is a very unusual thing that happens. And so because of that, you can expect that as we go through these periods, people are going to fret a great deal and fear a great deal. And in all likelihood, they'll sell stocks down, and then they'll come back to buy them again as it becomes clear that we are going through a period where prices will go down for any number of things because our technology is making them cheaper. And this is called a deflationary boom, because as prices go down, even if income goes up just a little bit, because prices are going down, even as income moves up, you can start to afford more and more things. Now, the danger in a deflationary boom is where there are old companies with old technology, obsolete services and products that have a lot of debt and can no longer pay their debt. Those companies are in big trouble, and they are going to go eventually bankrupt for sure. First, you'll see it happen a little bit slowly, and then you'll see it all at once. I believe in this current cycle, we are likely to see this happen slowly over time, and you're beginning to see some examples of it. For example, a company like Sears, that has been around for a very long time, that in its time was a pioneer, is now going bankrupt. And you can, if you read the news on a regular basis, you can see that in the places where technology has been moving for 10, 15 years, there are these big winners like Amazon, and there are these big losers like Sears, and you're likely to see more of that. And that, I believe, is a much bigger risk to you as an investor than the inverted yield curve, because of what I told you about. So that's my winning investor daily for this week, which is that in essence, the inverted yield curve is something that I believe actually represents a sign of the times, a sign of the period that we're in, where we have these incredible technological developments that are making so many of our product services better, cheaper, and that is going to be reflected in lower prices. And while there's great concern in the market today, I believe that the stocks to own are the stocks that are creating the deflationary boom. So the growth stocks of today, the technology stocks of today, And the thing to really worry about are the old companies that really reflect old ways of thinking, old technology, old products and services that are being wiped out by the new. So that's my Winning Investor Daily for this week. If you like this video, please give this video a thumbs up, subscribe to this channel, and share this with your friends and family. I'll have another one for you next week. Until then, this is Paul saying bye.